Welcome to this rapid fire explainer. Today, I want you to basically think of me as your sharp, on demand CFO. If you're an executive looking to really optimize your capital stock, well, you are in the right place. We're going to dive into a pretty ruthless, highly focused assessment of capital allocation and business financing. Because whether you're scaling up a mid market enterprise, launching some disruptive new products line, or just looking to aggressively expand your footprint, mastering your financing options, that is literally the ultimate architect's tool for growth. All right, let's get right to work. We are moving through a super tight framework today. 1. The growth capital imperative. 2. Leveraging internal capital. 3. External capital, specifically debt and equity. 4. Alternative funding streams. And finally, 5. The strategic decision matrix. Okay, let's dive into this. Section 1, the growth capital imperative. So how will you fund your next phase of growth? I'm posing this directly to you. Look, in the executive suite, having a massive vision is kind of irrelevant if you don't have the capital to actually execute it, right? The stakes here are incredibly high. A brilliant strategy that's unfunded is, frankly, just a hallucination. Your next phase of growth demands a very deliberate, strategic answer to this exact question. Now, what are we really talking about when we say business financing? Basically, it's getting the capital needed to start, operate, or aggressively expand a business enterprise. It's the fuel. Without this critical liquidity, honestly, even the most disruptive, market-ready ideas are just going to die on the vine. Capital is the oxygen for your enterprise. You cut the supply, and the whole entity starves. We're talking about equipment, inventory, payroll, rent, marketing, expansion. You know the drill. These are the absolute necessities that constantly drain your cash flow. You could probably rattle these line items off in your sleep. But consider this fact from U.S. Bank research. 82% of businesses that fail do so because of poor cash flow management. 82%. You are feeding a machine, and to make that machine run faster, it absolutely demands more fuel. All right, moving on to Section 2, leveraging internal capital. So internal financing utilizes capital that already belongs to the business or the founder. This is your ground floor lever for funding. It represents a high control, but simultaneously high personal risk approach to capital allocation. You aren't answering to outside boards quite yet, but you are putting your very own balance sheet on the line. The source material actually points out 3 primary sources of this internal capital. You've got personal savings, plowing back business profits, which we also call retained earnings, and selling unused assets. Essentially, this is about looking inward. It's optimizing what you already have and liquidating the completely dormant parts of your balance sheet to fund active growth. Of course, you've got to weigh the strategic trade-offs here. On the pro side, 0 interest payments, full retention of your equity and ownership, and incredibly fast unilateral decisions. But the cons? Well, they're equally heavy. You're strictly capped by your limited capital, and that intense personal financial risk, it's extremely high. As an executive, you must constantly weigh the heavy cost of personal risk against the sheer speed and agility of making decisions without a committee breathing down your neck. And this brilliantly illustrates the essential tension at the very heart of corporate finance. Internal funds give you high control, but strictly limited scale. External funds, on the other hand, mean lower control, but they unlock the potential for massive scale. This is your pivot point. When your ambition finally outpaces your internal cash generation, you really have no choice but to start looking outward. Which brings us to Section 3, external capital, specifically debt and equity. So, when those internal funds dry up, you face the 2 heavy hitters, the dominant external levers, bank loans representing debt and investors representing equity. Just about every major capital decision boils down to navigating the tension between these 2 exact columns. Let's examine debt first. Bank loans provide large funding for operations like major expansions, buying heavy machinery, or making long-term investments. But crucially, they must be repaid over time with interest. Now, while bank loans allow you to maintain full ownership of your company, so no dilution of your shares, which is great, they do introduce some incredibly strict, unforgiving burdens. You've got the heavy weight of interest costs, rigid monthly repayment schedules, and really rigorous approval requirements and covenants. Basically, you keep the upside, but you absolutely guarantee the bank their return. On the flip side, we have equity. Investors provide massive capital, expert advice, and vital networking access. But the cost is steep. You're giving up direct ownership in the company. See, investors are placing a bet on your future value. Pulling this lever means you don't have those monthly loan repayments bleeding out your cash flow, but you are sacrificing a slice of the business and officially inviting external influence right into your boardroom. You are literally trading your autonomy for their acceleration. Let's shift gears a bit. Section 4, Alternative Funding Streams. First up here is crowdfunding. This is where many people online fund small amounts, usually for early access or just because they believe in a disruptive idea. The pros? Well, you bypass traditional banks entirely, and it serves as a brilliant built-in marketing opportunity. It's like getting capital and market validation all rolled into one. But the cons are very real. There is absolutely no guarantee of success, and it requires aggressive, exhausting promotion just to cut through all the noise online. It's a great dual-purpose tool, but hey, if your marketing fails, you just get a very public rejection. Another alternative you might consider is government grants. This is government support that actually does not require repayment if, and that's a big if, strict conditions and eligibility requirements are met. This is essentially free money on your balance sheet, which sounds like a total dream, right? But I gotta caution you, grants come with incredibly rigid compliance, intense reporting structures, and massive eligibility hurdles. So while the cost of capital is zero, the administrative burden is incredibly high. So, the crucial point is how we tie this all together. Section 5. The Strategic Decision Matrix. I want you to run your current business unit through this rapid-fire sequential mental checklist. 1. Evaluate your business size. 2. Assess your exact growth stage. 3. Determine the precise amount needed. 4. Analyze your repayment ability ruthlessly. And 5. Ensure the capital aligns with your long-term goals. I challenge you to actually do this because, honestly, there is no one-size-fits-all solution here. A seed-stage startup is going to pull a very different lever than an established mid-market firm looking to acquire a competitor. Your capital structure must match your strategic reality. Our source material makes a really defining point here. Choosing the right financing method can make the difference between success and failure. I cannot emphasize this core thesis enough. Financing isn't just some back-office accounting function. It is the very foundation of your growth. The wrong capital can literally suffocate a great business, while the right capital acts like absolute rocket fuel. As we wrap up this explainer, I want to leave you with one lingering, provocative question. Which capital lever will determine your ultimate success or failure? Seriously, take a hard look at your own balance sheet today. Are you constrained by internal limits? Maybe you're over-leveraged with debt. Or are you finally ready to trade some equity for massive scale? The architecture of your business entirely depends on the foundation you lay today. Choose your levers wisely. Thanks so much for joining me on this explainer, and I'll see you next time.